Welcome back, grade 12 scholars, to this advanced macroeconomics explainer. My colleagues and I are thrilled to bring you this one. Today, we're going to systematically map out the baseline market and factor aggregates of an economy. It's a rigorous intellectual exercise, sure, but we'll be using precise ISC terminology to build a comprehensive framework, taking us all the way from observable market data straight down to pure factor earnings. Let's dive right in. Here's our syllabus for mastering national income today. We'll be progressing through GDP at market prices, adjustments for factor income, capital depreciation, and finally, isolating true factor costs.
Section 1. GDP at market prices. The geographical baseline.
Okay, so we begin our analysis at the broadest, most observable macroeconomic metric in literally any standard economy. Gross domestic product at market price, or GDP-MP, is the market value of all final goods and services produced within the domestic territory of a country during a given year, valued at current market prices. Now, the absolute key word here is domestic. We're looking at the sheer volume of economic activity strictly confined within a nation's geographical borders.
Because this is a strict geographical baseline, it indiscriminately aggregates the output of both domestic citizens and foreign entities. Think of it like a giant invisible fence around the country. If a foreign multinational corporation operates a factory inside that fence, well, that counts towards GDP Gump. But a domestic citizen running a business abroad, nope, that doesn't. GDP Gump cares purely about where the production happens, not necessarily who owns the means of production.
Section 2, Adjusting for Factor Income. Expanding to national borders. So to move beyond mere geography and capture the true earnings of a nation's citizens, regardless of where in the world they happen to be operating, we have to apply our first precise mathematical adjustment. We start with our baseline GDP-MP and add a crucial variable, net factor income from abroad, or NFIA. This transitions us seamlessly to gross national product at market prices, or GNP-MP. It's kind of like a massive economic swap. We're deducting the earnings of foreigners working inside our borders and adding in the earnings of our own citizens working outside them. Now, this dynamic can go two ways based on global economic flows. If our citizens earn more abroad than foreign nationals earn here, our NFIA is positive and our GNP-EMP mathematically exceeds our GDP-EMP. But if we pay out more to the rest of the world than we bring in, well, NFIA is negative, and our national product actually shrinks below our domestic baseline. Section 3, Deducting Capital Depreciation. The transition to net aggregates. While gross figures are fantastic at capturing total output, they have a pretty massive blind spot. They completely fail to account for capital consumption. You see, in the rigorous process of producing commodities, a certain amount of the economy's stock of plant, machinery, and equipment is inevitably used up or wears out during the year. Economists refer to this as the consumption of fixed capital. Gross product makes absolutely no allowance for this wear and tear. Net product, however, acknowledges this physical reality and deducts depreciation to give us a much more sustainable picture of our economic output. When we apply this deduction, our gross figures totally transform. Subtract depreciation from our geographical baseline, GDP-MP, and you get net domestic product. This is the measure of income actually available for consumption and new investment in the economy. Subtract depreciation from our national aggregate, GNP-MP, and you arrive at net national product, or NNP-MP. This reflects what's produced over and above the amount required to simply maintain the nation's existing capital stock. Because NNP-MP accounts for keeping the nation's capital stock intact, it really acts as our ultimate long-run gauge of true macroeconomic expansion. Think about it. If an economy produces a massive gross output, but completely destroys its machinery in the process, it hasn't truly grown, right? It's just cannibalized its future potential. NNP-MP adjusts for this, providing policymakers and economists with a far superior, clearer indication of sustainable, long-run economic growth. Section 4. Isolating true factor costs. Stripping away market distortions. All right, we've moved from domestic to national and from gross to net. Finally, we need to peel back the very last layer of government market distortions to isolate the raw, unadulterated earnings of our factors of production. Market prices, the prices consumers actually pay at the register, are inherently distorted. The price you pay is rarely the exact amount the producing firm receives. Why? Because of the government. Market prices are inflated by indirect taxes, which are emphatically not a part of factor earnings. Conversely, governments sometimes provide subsidies, which artificially depress market prices below the true cost of production. To find the real cost, we must calculate net indirect taxes, which is the mathematical difference between indirect taxes and subsidies, and systematically strip this distortion away. By subtracting these net indirect taxes, we successfully bypass tax distortions to arrive at gross domestic product at factor cost and gross national product at factor cost. What remains is the sum total of actual earnings received by the factors of production, completely free from the artificial price-altering effects of government taxation and subsidization. These final factor cost aggregates precisely isolate the sum total of raw earnings received by the fundamental building blocks of the economy. We're left looking purely at the raw economic lifeblood of the nation, the wages paid to labor, the interest paid to capital, the rent paid for land, and the profits generated by entrepreneurship. This accurately measures economic activity without all the noise of consumer price inflation caused by indirect tax policies. As we conclude this masterclass explainer, I want to leave you to ponder this vital question. We've journeyed all the way from the broad, geographically bound, tax-distorted GDP at market prices, systematically applying deductions for foreign income flows, capital depreciation, and indirect taxes, until we reached the absolute purest measurement of national income. So, how does strictly utilizing this deductive funnel empower you, as future economists, to bypass market illusions and assess the true economic reality and welfare of a nation? Understanding these adjustments really isn't just an academic exercise. It's the absolute prerequisite for any serious macroeconomic analysis. Keep dissecting the data, and we'll see you in the next explainer.